Nice to have you, Mr. Philip.
Hello.
How is visit to Korea this time?
Rainy. No, I'm joking. I mean, it's very interesting to see Korea because to check if what we see when we make international comparison and we see at the end of the day Korea is not in a bad shape. When you look inflation, it doesn't exist. Rate of unemployment is very low. No big government debt. External account in a positive territory, some growth. So when compared to many others, well.
So my first question is going to be regarding the U.S. economy as a whole. What do you think?
It's not that bad because you have this year a fiscal drag, which is important, not only because of a sequester and less spending, but also, as you know, at the beginning of the year, there was the creation of a new tax rate at 45%, plus more contribution to the social contribution. That's, of course, put a drag on incomes. And we forecast something like 2% growth, despite that fiscal drag, which is enormous. So if you are in the shoes of a Fed, you see, well, the situation is normalizing.
So do you think the U.S. economy has recovered already enough to think about the exit strategy?
I mean, if going forward, if you extract part of this fiscal drag, which will be the case next year, you have a normalization, growth accelerates. You have to end this strategy one day. Back in June 2011, they were talking about the exit already. Mm-hmm. What happened this year, that's my personal opinion, is that when the thing was announced in November or so, there was the fear of a so-called fiscal cliff. That would have put US in a recession. So as a monetary policy decision maker, you do something QE3.
Right.
From February or March, maybe there was no need of QE3 anymore. You withdraw the thing. Of course, it has an impact, but you have to qualify something. You have a decline in the deficit by something like, say, $500 billion. Okay. Mm-hmm. By the same time, so there's less supply than expected. By the same time, the Fed is buying tremendously, 40 billion treasuries, 85 total, 40 billion treasuries each month, which means what? Which means 500 in 1 year. So one could say the price of bonds were artificially kept low. Cannot go on forever like that.
Mm-hmm. So these days we are now looking at higher and higher U.S. yields trend.
Yeah, so, I mean the markets as often are not behind the curve, but ahead of the curve. And that was probably some misunderstanding in the field of communication between the Fed on the one hand and the markets on the other hand last month, which is, I keep accommodating, look, I will keep buying. Yes, but you're not buying as before, so you will end one day. As a precaution, I sell and rates go up. Mm-hmm. The market is ahead of the curve. So probably a lot of a correction is now done already.
But people say Bnp파리바, right, is now looking at more brighter side of the U.S. economy than the market. So what do you think?
Well, I mean, the market has been surprised in the communication because following a speech in I think it was the 22nd of May with the Congress, they say, we will slow down this QE3 provided there is a substantial improvement, blah, blah, blah. Markets were not happy. What is substantial? What is the timing? What is the quantity? Do you come from 85 to 70 to 75, 60? We don't know. What is the composition, MBS versus Treasury? So there was this uncertainty. Comes the FOMC in June. They add some clarification. We forecast a rate of unemployment at 7. Mm-hmm. If the reality comes there, we stop. And we begin by moderating. What did the market completely ignore that? What did the market look? It's two things. Inflation's going down, they don't comment on that.
Right.
Inflation as one is not in line with their target. And second, they said the downside risks to growth are not as important as before. That's what the market said. It was a conviction that they would, in a coming 1, 2, 3 months, begin to taper, as they say, this QE. So you sell before taking losses. You sell rates go up. It's self-fulfilling prophecies, or whatever it's called.
I see. Any side effects when the U.S. starts the exit strategy going forward?
It has started already by speech. Side effects mean you put rates down in the expectation that people take risk and buy more risky assets. Within most risky assets, you have corporate bonds, including junk. You have sovereign bonds of emerging markets, Europe, etc., etc. Okay. When the thing is not as attractive, the way back, and so you have some turmoil on the exchange rate. And to give an example, if we take just the month of June, from the first day to the last day, we have seen an increase without domestic reason in Euroland. We have seen an increase in rates, 10-year yields in Germany in the province of 30 basis points. This is the base rate, I would say. Spreads with countries like Italy and Spain also increased by 30 basis points. That is a total of 60 for these two. So it has an impact because the market is global.
What's your view on U.S. Housing market? Actually, the housing prices has gone up quite substantially over the past couple of years.
Yeah, I mean, there is a recovery which has taken place. Prices have increased on the province of 12-13% over the last year. Housing starts are comfortable. The inventories, either for existing homes or new homes, are hovering between 4 and 5 months, which is record low. So there is a potential to build more. Some people are a bit upset because the increase in rates, it's not just sovereign rates, it has a spillover to mortgage rates, etc. And of course that has a negative side effects, but I would say mainly probably on just first-time buyers, somewhat, but that's marginal. More importantly, maybe in refinancing loan that helps people to buy cars, etc. But when it comes to the real estate, to the housing market per se, strictly speaking, we have seen a recovery which has an image different from what it was before. Before, you had people buying homes. I mean, single household homes. I don't know what they call that. Now they have investors. They looked at low rates. Price had gone down. It's profitable to buy flats, buildings with flats. You rent. That was the core.
Because of low interest rate environment, right?
Yeah, and because the price has gone down, the yield of renting is okay. Now, there is something else. I mean, when you look at the amount of mortgage loans outstanding, in the first quarter, the Fed statistic, the flows of funds, it was still in negative territory, meaning that this recovery was a kind of creditless recovery in that segment.
So, in your opinion, there are some, bumpy kind of stuff in the U.S. economy.
I mean, when it comes to rates, when it comes to the economy, I mean, this speech about slowing down the QE and ending it next year has to do with the fact that the economy is going better. If the economy was not going better, they wouldn't stop that.
Okay.
So you have to mitigate the opinion. When it comes to rates, strictly speaking, it's inevitable that it is bumpy. Because if you are a central bank or whatever official institution, rates are at 2.5, and somebody asks you, your boss asks you, what is your forecast? You say, okay, 3.5, why not? And what in between? You don't have a clue. So you add 25 basis points each quarter, okay? The reality is never like that, because once again, people feel that, well, things will change, let's sell. And the thing comes very fast, because they are ahead of the curve. They try not to lose before the others. So we come before the others.
Okay. And what's your thought about the equilibrium in terms of rates, in terms of US 10-year Treasury notes? It's going to be like 3% or 4% in 12 months?
Well, I think 3% is more likely, because some people ask, is that comparable to the kind of burst on the bond market that existed in '94? I mean, we are in a very, very different situation because at that time, the Fed had to do with a labor market which was in full employment situation. It was increasing its Fed funds objective repeatedly and sometimes by 50 basis points. And so they increased by, I don't remember, but 5 or 6 times in a year, each FOMC. We are in a completely different situation. Something important.
Gotta be clean, gotta be mean, gotta be everything. Why don't you love me? Why don't you love me?
Good luck to CNBC. Bonne chance pour CNBC.
Thank you very much.
It's a pleasure. Thank you. Bye-bye.
Again.